Hello traders, welcome back to the Forex Jig. So the financial markets can be complex and overwhelming, but having the right technical indicators will significantly improve your trading decisions. So today you will learn about the best TradingView indicators that professional traders use to analyze market movements and identify profitable opportunities. These indicators have been tested across different market conditions and time frames, proving their reliability in both trending and ranging markets. Stay until the end as we will break down each indicator with real market examples and show you exactly how to implement them in your trading strategy. So without wasting your time, let's get started. This is the TradingView platform, of course, and this is the Australian dollar against US dollar on the daily time frame. So the first indicator, the first TradingView indicator on my list is the Ichimoku Cloud indicator. So I'm just going to add that Ichimoku Cloud. That is a TradingView indicator. Now it's kind of complex, but I'll explain it. So the Ichimoku Cloud is a powerful and comprehensive indicator that provides multiple insights into market trends and potential reversals. So this advanced tool offers traders a complete view of price action, momentum, and support/resistance levels all in one chart overlay, which is why there's so much information on the chart. So the Ichimoku consists of 5 key components. The first one is the Tenkan Sen, which is the conversion line, and it's a short-term trend indicator. Is calculated as the midpoint of the 9-period high and low. And the next is the Kiju Sen, which is the baseline and is a longer-term trend indicator computed as the midpoint of the 26-period high and low. And we have the Senkou span A, which is the leading span A, and it forms one edge of the cloud calculated as the midpoint of the Tenkan Sen, which is the conversion line, and the Kijun Sen, which is the baseline, plotted 26 periods ahead. Now the next is the Senkou span B, which is the leading span B, and it forms the other edge of the cloud calculated as the midpoint of the 52-period high and low, also plotted 26 period ahead. And the last is the Chiku span, which is the lagging span, and the current closing price plotted 26 periods behind. So these are all of them. The baseline is that red line, the conversion line is the blue line, the lagging span, as you can see, is the green line, the leading span A forms the edge of the cloud, and the leading span B forms the other edge of the cloud. That is your Ichimoku Cloud indicator. So how can you use this to trade? The cloud itself, formed between Senkou span A and B, serves as dynamic support and resistance zone. So when price is above the cloud, like this, when price is above the cloud, see price breaking through this cloud and staying above it. When price is above the cloud, it indicates a bullish trend, while price below the cloud suggests a bearish trend. The cloud's thickness can also indicate the strength of the trend. See if I see a better example. You can see this is a bigger cloud, and you can see this is a strong bullish move right here. This is another big cloud. See the strong bullish move right here. When price is trading above the cloud, it indicates that it's a strong bullish move, in the market, and if it's trading below the cloud, it indicates a bearish move at play in the market. So trading signals are generated when the Tenkan Sen crosses the Kijun Sen, which is when the conversion line crosses the baseline, which is the red line and the blue line. When they cross, when you have a crossover, it indicates signals, whether bullish signal or bearish signal, depending on the one that crosses over. So when the Tenkan Sen crosses the Kijun Sen, it's just similar to moving average crossovers. So you can expect a signal, a bullish signal, and when when the baseline crosses below the conversion line, you can expect a bearish signal. So that's how you can generate trading signals using the Ichimoku Cloud. You can see this price crossing below this right here, and you have your signal to sell. You can see immediately after that, price started selling to the downside, and have this cross here indicating this little bullish movement. Before we have another cross here, have this little bearish movement also. So that's how you can use the Ichimoku Cloud indicator. So the Ichimoku Cloud strength lies in its ability to provide a comprehensive view of market dynamics. By combining multiple time frames and aspects of price action, it helps you identify trends, gauge momentum, and spot potential entry and exit points with greater accuracy. So you can see this is how you can use the Ichimoku Cloud. You can see these points where we have these crossovers indicates they're just like moving average crossovers. Indicates trading signals to buy or to sell depending on which line crosses above each other. If it's the baseline crossing above the conversion line, you have a bullish signal. If the conversion line crossing below the baseline, you have a bearish signal. So the next indicator on my list is the Fibonacci retracement. Just gonna remove all of this. So the next on my list is the Fibonacci retracement. So the Fibonacci retracement is a widely used tool in technical analysis that helps traders identify potential reversal levels in the market. It is based on the Fibonacci sequence, which is a series of numbers that reflect natural ratios found in various aspects of life, including financial markets. So these ratios are 23.6. Let me just quickly put the Fibonacci. This is it. So this is how the Fibonacci looks like. Has the 23.6, has the 38.2%, have the 50%, have the 61.8%, and the 78.6%. So these are used to map out potential support and resistance levels during a price retracement. Keyword retracement. So when a market is trending, price does not move in a straight line. It often pulls back or retraces before continuing in the direction of the trend. And the Fibonacci retracement tool helps you measure how far the price might retrace before resuming its trend. So to use the Fibonacci retracement, you first identify a significant high and low point on your chart. For example, have this high and you have this low right here. And we expect price to give us a retracement after this move. And the way we can use to measure where price might retrace to is by putting the Fibonacci retracement on our chart from the high to the low, and then the tool then automatically plots horizontal lines at key Fibonacci levels between these 2 points. These levels act as potential zones where price might reverse or consolidate. You can see price reversing off the 50% level here and giving us good confirmation here, and price selling off, and take profit should be at this support level here. And you can see this high and this low, and if you plot your Fibonacci right there from the high to the low, you can see price retracing to the 61.8 level right here, which is the golden level. And you see price giving us this morning star candlestick pattern confirming the trade. You can see this downward movement, see this bearish movement after that. So this is how you can confirm, you can use to gauge your trading price reversals after a significant move in the market. So you can see this you can see retracement right here, and you retrace to the 61.8 level, which is the golden level, the golden ratio. You can see price had 2 taps into that level and give us a push to the downside to take off this support level right here. So that's how you can use the Fibonacci in your trades. The next on my list is the moving average, a very popular TradingView indicator which you can use in the market. So I'm just going to put the moving average on the chart. Moving average. So the moving average is a fundamental and versatile indicator in technical analysis. It smooths out price data to create a single flowing line, making it easier to identify overall trend direction. So the simple moving average is the most basic form of this indicator, which is this one I just put here, the SMA. And it's calculated by taking the average of a set number of recent price points. So SMAs are particularly useful in identifying trend direction and potential support or resistance levels. When price is above the SMA, it generally indicates an uptrend, while price below the SMA suggests a downtrend. See, I'm just going to increase SMA period to 50-day. You can see this. Okay, let me reduce it a bit to 21-day. Exactly. Now, like I said, when price is above the SMA, it means we are in an uptrend, and when price is below the SMA, we are in a downtrend. You can see this price going below the SMA, and you can see here price going above the SMA. So traders often use multiple SMAs with different periods to generate trading signals. For example, when a shorter term SMA crosses above a longer term SMA, it can signal a potential bullish trend reversal. Conversely, when the shorter term SMA crosses below the longer term SMA, it might indicate a bearish trend reversal. So I'm just going to add one more SMA to the chart to show you how that works. So I'm going to put a shorter term SMA, which is the 9 period, and this one is the 21-day period. You can see this cross right here signals, it gives us trading signals just like the moving average cross. It's very, very popular, and if you want an in-depth explanation of why this happens, you can check our channel. We've discussed that already. Go through our channel and you see lots of videos explaining the moving average. But when the shorter term SMA crosses above a longer term SMA, which is the 21 period here, it can signal a potential bullish trend reversal, which is what happened here. Though that reversal didn't last because we are in a downtrend in this case, but this is a perfect one here. This one here is a perfect example. So that's how you can use the SMAs. And remember, why SMAs are powerful tools? They are lagging indicators. This means they confirm trends rather than predict them. So for the best result, combine SMAs with other technical indicators and always consider the broader market context when making trading decisions. So that's it for SMAs and moving averages. So the next on my list is volume profile. Volume profile is the next on my list, and volume profile is a powerful analytical tool that displays trading activity at specific price levels, revealing where the most significant transactions occur in the market. So this indicator creates a histogram on your chart, showing you the volume concentration at different price points, helping you identify key support and resistance levels. So I'm just going to put the volume profile on my chart, and this is the volume profile. I'm going to start from 2024 to present day, and this is the volume profile. Okay, let me also put this on gold from 2024 to present day. You can see the volume profile. So the volume profile consists of three main components: the point of control, the value area high. Point of control is this red line, and the value area high is this high here where the shading stopped, and the value area low, which is this right there. And the point of control represents the price level where the highest trading volume occurred, making it a crucial reference point for future price movements. So the value area high contained between the value area between the value area high and value area low represents where approximately 70% of all trading activity takes place. As you can see it also in AUD USD. So these levels often act as support and resistance zones, particularly during trending markets. So when price moves outside this value area, like this one here, this is the value area from here to here. So when price moves outside this area, it typically indicates a potential trend continuation or reversal. And you can see here is a reversal. You can see this reversal here as price moved outside this value area here. We had this rejection, this strong hammer candle here, this reversals. This is another one. Price moved out of the value area and we had that hammer, and this is another one. Price moving outside the value area, and you can see price always coming back to the point of control to make reference, because that is the place that had the highest price volume during this period, and also uses it as support levels. You can see he always makes reference to the point of control, and it also uses the value area low, which is this right here, uses it as support. You can see that also. So understanding volume distribution helps you identify institutional trading activity Areas of high volume suggest strong price acceptance, while low volume areas often lead to quick price movements as traders seek better prices. So to use volume profile effectively in your trading, you should look for price rejection at high volume nodes. You should watch for quick price movements through low volume areas like this one here. Quick price movements. See this massive rejection count right here. After that, you should use the point of control, which is the POC, as a reference point for stop loss placement, and also monitor how price reacts when returning into the value area like this. Returning into the value area, you can see price giving us this minor reversals. You can use the Fibonacci as we discussed to know if price may return to the 61.8 level or the 78.6, and look for proper confirmations before you take your trades. So that is one way to use the volume profile in taking trades. So the next on the list, and is the final indicator which we'll be discussing for this video, is the moving average convergence divergence, which is the MACD. And this indicator is a versatile momentum indicator that helps traders identify potential trend changes and generate buy or sell signals. So I'm just going to put that on the chart, just insert that on the chart. MACD, moving average convergence divergence. So this is it. So it consists of two lines, the MACD line and the signal line, along with a histogram that represents the difference between these two lines. So the MACD line is calculated by subtracting the 26 period exponential moving average EMA from the 12 period EMA, and the signal line is a 9 period EMA of the MACD line. So these default settings can be adjusted to suit your different trading styles and time frames. You can see it, see right here. You can adjust all these numbers. So the primary trading signals from the MACD occurs when the MACD line crosses above or below the signal line. When the MACD line crosses above or below the signal line, you can see this. These are how the MACD line generates trading signals. See this one here also. You can see this one here. You can see this one right here too. And you can see how price is reacting when we have these crossovers, signaling trading signals. See how price quickly reacts to these levels. But this didn't last because we were in a bearish trend. The price giving us lower lows, lower highs, lower lows, lower highs. So a bullish signal is generated when the MACD line crosses above the signal line, indicating potential upward momentum, just like it did here, just like it did here also. See this. And conversely, a bearish signal occurs when the MACD line crosses below the signal line, suggesting potential downward momentum. So the MACD histogram also provides additional insights into momentum strength. When the histogram bars are increasing in height and positive, the green color, it indicates growing momentum in the current direction and indicates that we might be in a bullish trend. And when you see the red bars, the red histogram bars, it suggests that we may be in a bearish trend. And if you see decreasing histogram bars, it suggests weakening momentum and potential trend reversal. If you see weak bars like this one, is weak momentum. So you see when you see The histogram bars increasing in height like this one here, it indicates stronger trend. You can see this is a strong bullish trend right here at this lower and higher high break of structure right here, which is a strong bullish trend. And that's how you can use the MACD to generate trading signals in the market. And see this one here, see it, this was twice, give us the signal twice. This is one, you can see this, see this one also, but we were in a bearish trend, so we don't be taking this bullish signal generated here. See, we are in a clear bearish trend right here. So alright traders, you've come to the end of the video. Each indicator we've discussed offers unique insights into market behavior, from trend identification to momentum measurement and volume analysis. So by integrating these tools into your trading strategy, you'll be better equipped to make informed decisions and spot high probability setups. So if you found this information valuable, please hit the like button and subscribe to the channel. Don't forget to turn on the notification bell to stay updated with our latest trading insights and strategies. Keep learning, and I'll see you in the next video. Happy trading.